Hello there, my name is Michael. In this video, we are going to talk about what Forex is, explain how it works, and also we're going to do some few calculations, how to calculate your profit. Yes, that's very important, seriously. You want to know how much you have made each pip. And also we're going to be talking about some of the Forex terms that is commonly used. Also watch out for the part 2. Let's go. So, what is online Forex trading? The foreign exchange market, otherwise known as the forex market, is a worldwide, decentralized, over-the-counter financial market for the trading of currencies. Forex traders trade currencies of different countries against one another and take advantage of the exchange rate fluctuations which occurs almost every second. I mean, imagine if you buy an apple at 5 naira, then in the next minute the price rises to 7 naira and you sell it at 7 naira. So you know the kind of the profit you have made on it. That's almost like what Forex is. Every single second the price keeps on changing. It can also change for the good or for the bad, depending on how much you bought the currency you're currently holding. Because sometimes you could have bought the currency maybe at 5 naira and later it drops to 3 naira, so or $3. That will be a loss. So which means you have to wait for it either to rise back up to 4 naira or higher than that so that you can make your profit. Forex broker provides the platform where the traders receive price data and financial charts which he will use to base his trading decisions, place a trade, order and close a trade position. Basically, that is what the MetaTrader is. Your broker supplies the information to the app. You see what is happening in the market, then you decide whether you're going to buy or sell. Then you say, okay, how is the current the order I'm in, the current trade that I'm running, is it going okay, is it going badly? So in point, the broker gives you the information, the data you need to trade, and that's what the MetaTrader 4 or MetaTrader 5, depending on what you're using, is. It allows us, the traders, to see what is going on in the market, and so that we can make the right decisions that will make us money. In forex trading, currencies are traded in pairs. For example, Euro/USD. So we can say the Euro is the base currency while the USD is the quote currency. Or we can also say one is a buy and one is a sell. So once you are buying one, you are selling the other. The transaction process is explained as follows. A trader analyzes the forex market using either technical analysis, fundamental analysis, or economic data to predetermine that the euro will rise in price and the US dollar will fall in price. The trader therefore quickly buys the euro and sells the US dollars at the same time. So you can see both things are going on. Either you're buying then you're selling, or you're selling and you're buying. So it's either way. We assume that eventually the prediction of the trader came to pass. The euro rose in price and the US dollar fell in price as predicted. The distance between the original price before the trade and the current price will be calculated to ascertain the profit of the trader. So that's how you make your own money, based on the difference in price. Profit calculation using fractional pip pricing. Pip is an abbreviation for percentage in point. So that's the meaning of pip. Each time you hear them talk about 7 pips, I made 8 pips, and that, it just means percentage in point, which is the smallest price movement in forex trading. If euro/USD quoted as 1.3571 and the price moves to 1.3575, this is a 4 pip movement in price. For instance, 1.3575 minus 1.3571 will be 0.004. So in calculation, basically you put the higher one on top of the lower one. It's just normal math calculations, and once you're done calculating, you probably get 0.0004. That's what you're going to get once you're done calculating it. Some brokers do quote price in 4 decimal places, while some quote in 5 decimal places. For example, 1.35713. What is your lot size? You would ask. Your lot size is the volume of your margin deposit used to file your order. If I send $1,000 to my broker as the margin deposit, and I use 0.1 lot for my trade, each pip I make as profit will be equivalent to $1. If I made 4 pips, it means I made $4 as profit. If I choose to use 1.0 lot to fill my position, it means each pip will be equivalent to $10. Consequently, the 4 pip profit will be $40. This has its own advantage and disadvantage. So as you can see, the bigger the lot size, the more money you make. But the little issue there is that if the bigger money you make, it also means if you lose, you also lose a lot of money. So most times it's advisable that you trade with the micro. The micro, that is 0.01. That is the micro. While we have the mini, which is 0.1, and which we have the standard lot size, which is 1.0. So the standard lot size is 1.0, the mini is 0.1, and while the micro is 1.01. It's advisable, especially if you're starting, you're just learning to trade, that you trade with the smallest lot size so that you don't lose your money, because it only takes a few seconds before you become broke when you're trading. Considering the explanation above, you should wonder how $0.004 could amount to $4. This is made possible through leveraging. Leverage ratios are available between ratio of 1.1 to 1.500. In the example below, I will explain how a leverage ratio of 1.100 can create liquidity for 100,000 positions. using an account size of $1,000. The average ratio of 1.100 will add 2 zeros to the available margin, which we assume to be 1,000, and create liquidity for a 100,000 position. However, if during the trade price goes against the trader prediction and he loses an amount up to his initial margin deposit of 1,000, all his positions will be automatically closed. Otherwise, he will receive a margin call. A margin call is a request from a broker to a trader asking the trader to add more funds to his account in order to maintain his position. Well, basically this just means that, okay, when you put let's say you put 1,000 naira or $1,000 into your trading account, and the leverage, depending on the leverage you pick, you could pick maybe 1.500, 1.1 or 1.100. Depending on the leverage you pick, it will determine the amount you see, it will determine the leverage you are giving. So we can see 1,000 will increase. If you choose a leverage of 1.100, that will give you an 100,000 leverage to trade in the forex market. But the other thing there is that if you lose the amount of money that is equivalent to your deposit, automatically you'll be logged out of the market or be asked to fund your account. Referring to the 4 pips profit we explained earlier, we will simplify the calculation, which makes for $10 per pip possible using 1.100 leverage. Since the broker provides liquidity worth of 100,000, we will multiply 0.004 by 100,000. Then at the end of the calculation, we're going to get $40. High leverage has its own dark side. For instance, if a trader uses 1.0 lot on an account of 1,000, it means each pip will be equal to $10. Consequently, if the trader loses 100 pips, the whole account will be wiped out. Okay, now let's calculate our pips and our profit. To calculate our pips, we get the number when we entered into the market. So we entered into the market at 1.3571, and we left the market, that's closing an order, at 1.3575. Then we minus it, and we get, that's 1 minus 1, we get 0, 3 minus 3, 0, 5 minus 5, you know the rest, 0. Then we come to our last number, which is 5 minus 1, and we get 4. So that automatically means that there was a movement of 4 pips. Remove the zeros. Just remove the zeros and a point, and just we have our 4 pips. Then we move to calculate our profit. You go to 0.004 times. Okay, so we go to the right where we want to calculate our profit. We put the point movement, which was 0.0004 times our leverage, which is 100,000, and we times it. Once we times it, then we put our point. So we count from the back, from the right, how many figure before the point. So we go to 1, 2, 3, 4. So we have 4 numbers before the points coming from the back. Then we come down and we count. Okay, so we have we have 5 zeros and a 4. So we count from the back 1, 2, 3, 4, and we put our points there. So our point is now between the 5th zero and the other 4 zeros, which, moving on, we now have $40, which is our profit. So that's how you calculate your profit. The forex trading nomenclature, there are different terms and definitions you need to understand. As a new trader, in this video we will explain the most common and the most important terms you will come across. AUSSIES, forex slang name for the Australia dollar. Ask price, the price at which a trader can buy a currency pair, also called the offer price. Broker, the market participating body which serves as the middleman between the retail trader and larger commercial institutions. Bid price, the price at which the trader can sell a pair. Bullish market, a market characterized by an upward move in price. Bearish market, a market characterized by a downward move in the market price. Cable, a forex trader slang word for GDP/USD currency pair. Carry trade, in forex holding a position with a positive overnight interest return in hope of gaining profit without closing the position just for the central bank interest rate difference. CFD, a contract for difference, special trade instrument that allows financial speculation on stock, commodities and other instruments without actually buying. Commission, broker receives commission for operation handling. EA, expert advice, so an automated script which is used by the trading platform software to manage positions and order automatically without or with little manual control. So basically you can see this when you download MetaTrader 4 on your laptop. As it says, it can make trade on your behalf, but I do advise most times if you're going to make a trade, if you just do it yourself instead of using a bot to trade. Because sometimes you might have heard people say you can use bots to trade and it works, but you have to be careful because sometimes you could also make losses. It's not 100%, so most times I do advise you should trade by yourself. Gap, a difference between the previous period close price and the next period opening price. In forex, a gap usually only occurs during the weekends between the Friday close and the Monday opening price. So if you want to know, if you're new to forex and you live in Nigeria, by 10 o'clock every Friday the market closes, then opens around maybe 12 on Sunday midnight, and like if you're crossing over to Monday, basically 12, that's when the market opens again. So from Friday to till Sunday night, the market is still going on, but you don't have access to it. Like other people are logged out of the system, but some other people can still trade. Maybe the banks and some other institutions can still be running trades, but normal traders like us normally logged out from Friday 10 p.m. till Sunday around 12 or 11 till the market opens, 11 p.m. or 12 a.m. when the market opens again. GDP, gross domestic product, is a measure of the national income and output for the country economy. It's one of the most important forex indicators. Hedging, maintaining a market position which secures the existing open position in the opposite direction. So basically GDP, I just want to talk about this. In forex trading, you can look at the economic of a country to know whether you want to trade in that in those country currency in their pairs or not, because you can check, okay, is this country good? I mean, is the economic going, is it rosy, is it going high, or are they having problems, infighting, weather issues, or war going on? You know, once there's trouble going on in a country, you know that they're not going to be producing anything they can sell out to other countries. The economy is not going to be going that well. So the GDP is one of the things people look at when they're choosing a pair to trade in. Kiwi. Yes, we are not talking about the Polish. We're talking about terms used in forex. Kiwi, a forex slang name for the New Zealand currency, New Zealand dollar. Limit order, order for a broker to buy the lot for fixed or less price, or sell the lot for a fixed or better price. Such price is called limit price. Liquidity, the measure of market which describes relationship between the trading volume and the price change. Long, the position which is in a buy direction. In forex, the primary currency when bought is long and another is short. Loss, the loss results from closing long position at lower rate than opening, or short position with higher rate than opening, or if the profit from a position closing was lower than broker commission on it. Lot, definite amount of units or amount of money accepted for operation. Handling, usually it is a multiple of hundreds. Margin, money the investor need to keep at broker's account to execute. That means the money that you need to pay into your broker's account so that you can trade. Trades, it supplies the possible losses which may occur in a margin trading. Margin account, account which is used to hold investors' deposits, money for forex trading. Margin call, demand of a broker to deposit more margin money to the margin account when the amount in it falls below certain minimum. So which means if you're in a trade and you are losing and the amount of money you have in your account is very low or is up to the amount that you deposit. Let's say you deposited 1,000, you're making a loss of also 1,000. Margin call will be activated. The broker will be asking you, hey, to maintain this position, you need to refund your money. You need to fund your account with more money so that you can continue trading. If not, you're going to be logged out till you refund again. So market order to buy or sell a lot for a current market price. Well, basically that's all we can take for now. There will be a part 2 of this video. We're going to continue talking about the terms used in forex in the next video. We're also going to do more calculations, how to know your profit, more on your lot sizes. We're just going to go a little more in depth into more of the calculation and explaining some things. I hope you love this video. Please subscribe, leave a comment, and hit that like button. I also want to thank Michael and Amarachi and K-Zone who commented on my videos. I just want to say thumbs up, guys. Thanks very much. Bye. Have a great day.